Today, we're going to pull back the curtain on a really powerful and often kind of invisible force that's shaping the stores you shop in and the products you buy. And it might just be the reason your favorite brand, well, isn't what it used to be.
I mean, you've probably felt this, right? That favorite local restaurant where suddenly the portions got smaller. Or that brand of shoes you love that just doesn't seem to be made as well anymore. It feels kind of random, but a lot of the time, it's not.
Because behind a lot of these sudden, disappointing changes, there's often one single answer: a private equity takeover. Now, that's a term you've probably heard thrown around, but what does it actually mean, and how does it work?
Well, it all starts with this really clever financial maneuver. You could call it a debt trick, one that lets a firm buy a whole company using money that, well, isn't theirs. They do it by borrowing against the future of the very company they're buying. Okay, so what is private equity? At its core, a PE firm is just an investment company that buys entire businesses. The best analogy is probably flipping a house just on a massive corporate scale. They buy a company, try to make it look more valuable as quickly as possible, and then sell it a few years down the road for a big profit.
And look, it's easy to get these guys confused with other players in the financial world. Private equity is totally different from, say, venture capital. VCs are the ones funding brand new startups, and it's not like hedge funds, which are aggressively trading stocks. Nope, private equity firms specifically go after older, established companies. You know, the brands you already know and maybe even love. The main tool in their toolbox, the signature move, is something called a leveraged buyout. You'll hear it called an LBO. The key word here is leverage, which is really just a fancy way of saying they use borrowed money. And I mean a lot of borrowed money.
So let's walk through this with a super simple example. Say a PE firm wants to buy a company called We Shoes, and it's worth $100 million. Now, they don't pay that full price themselves, not even close. They might put in, say, $20 million of their own money and then borrow the other $80 million. And then, here's the trick. After the deal is done, they take that massive $80 million loan and just transfer it right onto We Shoes' own balance sheet.
And just like that, poof, the shoe company is now saddled with $80 million in new debt. Debt it never asked for and had nothing to do with. So from day one, its number one priority is no longer making great shoes. It's about scraping together enough cash to make these huge interest payments.
And listen, this isn't just some made-up scenario. This is almost exactly what happened to Toys R Us. After a leveraged buyout, the company was so buried in debt that it couldn't afford to do anything. It couldn't invest in its stores, couldn't build a website to compete with Amazon. That debt is what ultimately crushed a childhood institution.
So you're probably asking, if the company they just bought is drowning in debt, how on earth does the private equity firm make money? Well, they have a playbook designed to squeeze every last drop of cash out of that business, and to do it as fast as possible.
This playbook usually has a few core moves. First, you cut costs, and you do it aggressively. That almost always means layoffs and switching to cheaper materials. Next, you raise prices. Then, you start selling off valuable assets, like the company's real estate. And if that's not enough cash, you might even force the company to take on more debt, which you can use to pay yourselves special fees and dividends, all before you try to sell whatever's left of the business.
Let's zoom in on just one of those tactics, the sale-leaseback. It's a classic. So before the buyout, a company might own its stores, right? That's a huge asset on their books. The PE firm comes in, sells that building for a quick pile of cash. But now the company is stuck paying rent on the building it used to own every single month. They've turned a valuable asset into a long-term, cash-draining liability. And again, this isn't just theoretical. We saw this exact play run on brands like Red Lobster and Marsh supermarkets. These deals put such immense financial pressure on the businesses that it became almost impossible for them to just operate day to day, let alone think about growing. So, okay, the PE firm has its playbook for making a profit. We get that. But what is the real cost of these strategies? Who actually ends up paying the price for all this?
The impact is huge. And it's not just an abstract financial game on a spreadsheet. It hits real people, workers, customers, entire communities, and, increasingly, even tenants who live in apartment buildings owned by PE firms.
I mean, the human cost is just significant. Workers are almost always the first to go in layoffs. The ones who get to stay, they're often overworked and stressed. And as a customer, you feel it too, right? You're paying higher prices for lower quality stuff and worse service. When local stores close, whole communities can lose their only grocery store. And when PE firms buy up apartment buildings, tenants almost always see their rents shoot up while maintenance just disappears.
But here's the most controversial part of this whole model, the real kicker. The private equity firm can make a fortune even if the company they bought goes completely bankrupt. How? Because they pull their money out early by charging massive fees, paying themselves special dividends, and selling off assets. They can walk away with millions long before the business finally collapses under all that debt.
So you're probably wondering, okay, if this model can be so destructive, why on earth is it so common? What are the systemic forces that are allowing this to grow?
Well, it really comes down to a few key drivers. For years and years, super low interest rates made it incredibly cheap to borrow billions of dollars for these buyouts. At the same time, huge investors, think pension funds, university endowments, they've been pouring money into PE, all chasing higher returns. And of course, struggling companies are always easy and cheap targets, while financial regulations have just been too slow to keep up with it all.
And this model isn't just staying put, it's expanding. In just the last few years, private equity has moved aggressively into what you might call essential recession-proof industries, things people need no matter what the economy is doing. We're talking about housing, emergency rooms, food supply, and even childcare.
And the trend here is crystal clear. While retail and restaurants were the classic PE targets for a long time, the real growth, the explosion, is happening in these essential sectors like housing and healthcare. Why? Because they're stable, reliable sources of cash flow, which makes them absolutely perfect targets for the playbook.
All right, so we've covered a ton of ground here. Let's just take a second and boil this all down to recap the entire process one more time.
It really all comes down to this simple 4-step pattern. 1. A company is bought, mostly with borrowed money. 2. That debt gets loaded onto the company's own books. 3. Cash is pulled out through any means necessary. Fees, cost-cutting, selling off parts. And 4, the PE firm sells what's left, often walking away with a huge profit, even if the business is basically a hollowed-out shell of what it once was. You see, this isn't just a story about finance. It's a pattern. And once you see it, you really start to notice it everywhere. So the real question I want to leave you with is this. Now that you know the playbook, where are you going to see it next?